So let's start with the jobs report, then we'll get to this messy market. Your reflection on the numbers that came out 30 minutes ago.
Well, it's easier to describe the job market than the actual financial markets. I will start with this. I think Mike McKee described it exactly right. I mean, it's a number not terribly different from what we saw last month, and it's not going to do anything to deter where the Fed is going. I mean, it was strong enough for the Fed to keep going across every metric. Jonathan, the thing that I think that I'm watching like a hawk now is I do think what Michael was saying, some of the things are transitioning a bit. And so you can look at, one of the numbers I focus on is business services and temporary hiring. Well, temporary hiring the last couple of months has been flat. In a hot job market, you generally don't see that. So watching some of this data and, the average hourly earnings, maybe not as strong. Listen, I think we're watching them, and boy, I read a lot of earnings reports. I do think, when you hear, and as Michael said, Amazon came out and said, we're going to slow down the pace. I do think we're transitioning, not enough to a slightly less robust labor market, not enough to take the Fed off its path. But I think the next few weeks, I should say, you're going to see some companies pulling back. I think interest rates are biting. I think input costs are biting. And I think companies you see this in earnings reports, they're talking about uncertainty, hard to project forward. And I would be surprised if you didn't see some hiring start to slow down on the backside of that.
Rick, that begs the question, the trillion-dollar question then. The implications for your investment decisions, what are they?
So listen, I think the overriding principle for all investing today is financial conditions are tightening. And the Federal Reserve has got to execute this plan to bring inflation down, which I think inflation is starting to come off the peak. Employment, I think, is going to start to come off the peak. The question is, both of those are structurally going to be high for a while. So employment high and inflation high. So listen, they got to keep going, and I think as an investor, you got to be patient. And I know I said it last month on your show. I think the top part of my priority set is patience. And I think you've got to continue to be there. Hold high levels of cash. I would say the one thing, Jonathan, that we're starting to do, some of the high quality parts of the market, things like investment grade credit, AAA asset backs, with yields moving up this much, you don't have to take a lot of what we call down the stack risk, equities, high yield, and you get some real yield in the portfolio. So we've been starting to add there. And the other thing that I think is really interesting, people are paying for insurance. I did a presentation yesterday. We talked about we're in the middle of a hurricane, and coming out of a hurricane, you want to sell insurance. That's what insurance companies do really well. Volatility markets are incredibly high, and as long as you keep your risk down, you can sell some volatility. And so we've been executing on some of that. I mean, these are incredible levels of vol, as you described at your opening.
Rick, just walk us through it. Is that an up in quality trade from high yield to IG, or are you taking that cash position over to IG? What are you doing?
So the first thing is we're holding our cash with both hands, and we still like holding a lot of cash. But we've been, and I know I said on the show with you last couple of months, we've been reducing the high yield exposure to pretty low levels. I still think that's the right place to be. And by the way, spreads in high yield are not cheap enough yet. I mean, they're still too tight. The thing we've also been doing is we've sold down a lot of loans. I mean, think about it. You needed floating rate exposure for a while at the inception of a rate rise. Boy, the amount you've moved already, floaters are not that interesting anymore. I'd rather take high quality, give me 2-year investment grade, 3-year investment grade, AAA securitized at 4.5%, 5.5%. Those assets are pretty good, and I wouldn't mind just holding on to those and high levels of cash for a bit of time, and let the market do what it's going to do while the Fed is tightening financial conditions.